So for this lecture, we'll talk about the balance of payments, right? So the balance of payments is basically just a balance sheet that the central bank keeps to keep track of transactions going in and out of the country, right? So this is a bookkeeping issue for governments. So for this topic, we'll introduce the different components of the balance of payments. We'll talk about the current account. So this account is for us to record trade transactions. So when you export or import. The capital account is for financial transactions, so financial investments across the border. Statistical discrepancy is something like an error term, right? So if you can't reconcile the two accounts, then you need to introduce an error term. Official reserves account, this is to record the transactions done at the central bank level when they buy and sell reserves, right? We will then talk about the balance of payments identity, and finally we'll talk about different trends in the balance of payments in different countries. Yeah. So, as we mentioned before, the balance of payment is a way that companies keep track of transactions in and out of the country. So, this is to record the country's international transactions over a certain period of time, normally a quarter or a year, right? So, this balance of payment follows the double entry bookkeeping, meaning that for every transaction you will have two different entries, one credit and one debit. So anything that is a receipt from foreigners, so for example, we get money going in from outside of the country, is recorded as a credit, so this is a positive cash flow. And anything that we pay to our foreigners is recorded as a debit, so this is a negative cash flow, right? So for example, let's look at a few transactions between the US and another country. So suppose we are a US citizen, right? And we want to create a record for these different transactions. So in this transaction, we have a US company being Boeing, and they exported a plane to Japan Airlines for 50 million USD, right? Japan Airlines pays from its dollar bank account kept with Chase Manhattan Bank in New York City, right? So for this transaction, we as a US company, we are selling to a foreigner. So when we sell something, we get the money back, right? So this is a positive cash flow to the US, okay? In the second example, we have the same company being Boeing. And in this case, we are importing, right? So we're buying things from outside. So we buy jet engines from a UK company for $30 million. So because we're buying something, we have to pay money to our foreigner. So this is a cash outflow for the US, yeah? In example 3, we have a US company acquiring another company in the UK. So this is a financial investment, right? So we are investing outside by acquiring another company in a foreign country. So because we're buying something, we're paying money, yeah? So this is a negative cash flow again, okay? So to summarize, for the first transaction, when Boeing sells an airplane to Japan Airlines, because we're exporting, we have a positive cash flow here, right, that we record as a credit. And because this is a double entry keeping, so we have to record another transaction, which is a withdrawal from the bank, from a US bank, by $50 million, right? So this is when Japan Airlines withdraws their money from a US bank to pay to Boeing, okay? In the second transaction, we do the opposite, yeah? So in this case, we're buying something from overseas, and because this is a buy transaction, we have to pay money to our partner So this is a debit transaction, yeah? So because this is a double entry bookkeeping, we record another entry, which is a deposit at our bank for $30 million, okay? Similarly, for the third transaction, when we go and buy a company in the UK, because we're paying money to the overseas partner, and in turn, they deposit the money back into the US securities, right? So this is a positive credit. Okay. So in the exam, when you have a question about the balance of payments, just remember that it's a double entry bookkeeping. So you have to have two entries for each transaction, yeah? So in terms of the balance of payments, the government classifies the transactions into 4 different accounts. The first one being the current account. This is when they record their trades, so anything to do with exports and imports. Yeah. With the capital account, this is when they record financial transactions. Yeah. So you go and you acquire another business, for example, overseas, or when you go and buy shares in a different countries. Okay. The official reserves account is there to record transactions done by the central bank. So anything to do with foreign reserves, when we buy the USD, for example, okay, for our reserves. And the final account is for any error recording, right? So anything to do with any discrepancies between the 3 previous accounts, right? So the reason why we have discrepancies between the accounts is because sometimes transactions are very hard to record, yeah? Especially with financial transactions. Sometimes it's quite hard to record. So sometimes the accounts will not reconcile, okay? So we introduce the statistical discrepancy to make sure that the account is balanced, okay? So let's look at an example. So in this example, I have a US balance of payments, and this is from 2015. The figures are in billion dollars, right? So this is in US billion dollars. So if you look at their balance of payments, you will see 4 different types. You will see a current account where they record their exports, imports. Unilateral transfers are things like foreign aids. So when you go and you help a country in need, right? Capital accounts. So this is where they record direct investments overseas, portfolio investments, so financial investment. Other investments. So this includes something like dividend payments, right? Or interest that you earn from your previous investment. Statistical discrepancies, this is when we reconcile the differences between the accounts. And finally, the official reserve accounts, right? So when you see a positive number, that means it's a positive cash flow for the US. And if it's a negative number, it's a negative cash flows for the US, yeah? So let's go through each of the accounts in detail. So with the current accounts, this includes all the imports and exports that we transact with other countries. It also includes unilateral transfers, like we mentioned before. So these are things that we help other countries, right? So unilateral, we don't get anything back. So when we import, we get the goods, but we have to pay the money, right, to other countries. When we export, we sell the goods to other countries, but we get the money back, yeah? So anytime when a country imports more than exports, this is when they have a trade deficit, right? So when they pay more than they receive, this is when they are a net consumer, and therefore they would have a trade deficit, okay? And vice versa, right? So if they export more, then they have a trade surplus, okay? So for example, if we look back at the balance of payments in 2015 for the US, what we see here is that in terms of exports, So overall, the US gets 3 trillion USD in exports, right? So they get this much in revenue for selling their goods and services. In terms of imports, it looks like they import a little bit more, right? So they buy more goods and services from overseas rather than they sell goods and services to other countries, okay? So looking at these two numbers here, it looks like they are going to run a trade deficit in 2015, right? So taking into account the unilateral transfer as well, if we sum up the sum of 1, 2, and 3, so 1 being exports, 2 being imports, and 3 being unilateral transfers, we will find that they run a trade deficit of about $463 billion in 2015, right? So what this number tells us is that they have to pay, so the money goes outside of the US for 463 billion USD, okay? Because they are the net consumer. So the next account that we look at is capital account. So this is the one where we record all the investments, right, financial transactions between countries. So if we think about a US company, if we go out and invest overseas, would we record that as a positive cash flow or a negative cash flow? So if we go to buy a business overseas, negative, right? So we have to pay the trade partner, so it's a negative cash flow for us, and vice versa, right? So if someone buys US assets, then the US will record that as a positive cash flow because they have to pay to the US, okay? So in 2015, the US had a balance of capital account of 188 billion USD. That means they have a positive cash flow going into the US, right? So investors from outside invest more in the US than US investors do outside, okay? So how do we read this information? So for example, in terms of direct investments, so these are things like when you go outside of your country and build factories or buy businesses outside, right? So that's called direct investment. So this number means that there is a positive $379 billion flowing in the US, right? So this is foreign investors directly investing in the US for around $380 billion, okay? In terms of US investors, they invest outside for about $348 billion, okay? So this is a negative cash flow, so cash going outside of the US, okay? Portfolio investment, so similarly, these are investments outside or inside the country, but in terms of financial assets, right? So you're buying shares, you're buying bonds, so on and so forth, okay? So $276 billion means that foreign investors buy financial assets in the US for this amount, right? And this is how much US investors buy foreign financial assets, okay? So overall, if you add up all the financial transactions for the US in 2015, you will find that they have a positive balance, right? So they have a positive capital account balance, meaning foreign investors invest a bit more in the US than the US invests outside. Next, so we have statistical discrepancy. So this is what we mentioned before. So this account is there to reconcile any differences between the accounts, right? Between the main accounts. So in this case, in 2015, the discrepancy in the US balance of payments is quite large. It's about $267 billion, right? So it's a very sizable discrepancy, okay? So comparing the two numbers between the current account and the capital account, it looks like the discrepancy comes from the misclassification of the capital account, right? Finally, we have the official reserves account. So in this case, for the US in 2015, they have a positive 6.3 billion USD in their official reserve account. So given that this is a flow, right, this is a statement of flow, what do we say about the US reserves? Did they increase their foreign reserves or did they decrease their foreign reserves? So when we see a positive number, that means it's cash flowing into the US, yeah? So in this case, the US government, the central bank in the US, gets 6.3 million USD, okay? So if the central bank receives the USD, that means they are selling off some of their foreign reserves, right? So in this case, they are decreasing their foreign reserves, okay? So if this is a positive number, that means the central bank receives the USD going into the US, which means they reduce their foreign reserve, okay?
Would that appreciate the currency?
Yeah, good question. So what do we think? Would that appreciate or depreciate the currency? So that would likely increase the value of the USD, right? Because the central bank is demanding the USD. Okay. Good question. Okay. So we talk about the different accounts in the balance of payments, right? So this is pretty much like an accounting exercise where we classify different transactions somewhere in the book. So with the balance of payments, an important condition is that this account should be balanced, meaning that the sum of the three main accounts should sum up to 0, right? So when you have a positive current account, that means you have a trade surplus. That means you are selling more goods and services to outside, right? So when you are a net seller, you would expect to have more money going into your account, okay? Which means your capital account should be negative to offset the change in your current account and vice versa, right? So if you run a trade deficit, then you should have a positive capital account, okay? So with a purely flexible exchange rate regime, this is when your currency value is fully determined by the market, right? So in this case, in theory, then the central bank would not intervene at all, and therefore the reserve account should not have any value, right? So there should be no change in your reserve account. If that's the case, if you truly have a pure flexible exchange rate regime, then the sum of your current account and your capital account should be 0, okay? So one perfectly offsets the other. When you don't have a purely flexible exchange rate regime, if you have a fixed exchange rate regime, then this account might not hold. So sometimes the balance of payments might be positive or negative, depending on what your central bank decides to do. Right. Okay. So in the next few slides, we'll look at how a change in the balance of payments might affect the demand and supply of your currency and therefore the value of your currency. All right. So this is just to summarize. So this is just what we talked about before. So in 2015, when we look at the current account for the US, they are a net buyer of goods and services. So they import more than they export. So their current account is running a deficit. Yeah. If this is the case, we would expect their capital account to be positive meaning that they should have more flows, more capital flows into the country. Okay, so foreign investors should be investing more in the U.S. Economy. So in theory, if the transactions are perfectly recorded, these two numbers should be exactly the same for a floating exchange rate regime. But in practice, because of the different misrecordings, then there is some certain error terms in here, right? Now, even for the US is considered a free market, right, where the currency is floated. But even for the US, sometimes you will see some activities by the government, right? So in theory, if you have a pure flexible exchange rate regime, then this number should be 0, okay? But in practice, sometimes the government intervenes, okay? So if we sum up the totals of the 4 accounts in the 2015 balance of payments by the US, we will see that they should add up together, right? So the balance of payment should be identified. So the 3 accounts, the current accounts, the capital account, and the statistical discrepancy is exactly equal to the official reserves, right? So that the balance of payment would be identified, okay? So when we think about how the balance of payments might affect the value of your currency, so any change in the balance of payments will affect either the demand or supply of your currency, and therefore it might change the value of your currency, right? So as a general rule, if we buy things from overseas, that means we have to pay to our trade partners, right? So every time when we pay, we supply the USD, we supply the local currency to the world, right? So as a net importer, therefore, we would expect to increase the supply of our currency, okay? So when you buy things from overseas, you supply your currency to the outside world. Alternatively, if you sell things to your trade partners, if you sell things to overseas partners, then when people pay to you, they will need to demand your currency, right? So they need to convert their currency to yours, thereby increasing the demand of your currency, okay? Similarly, so when we have a US government selling the dollars, so when the US government have to buy foreign reserves, they would have to exchange that with their own dollars, right? So when they sell the dollars, therefore, they increase the supply of the dollar in the world, okay? So for example, in this case, this is what we see, right? So for the US in 2015, they are a net buyer of goods and services, yeah? So their current account balance is negative, okay? So because they buy a lot of goods and services from outside, they pay you using the USD, and therefore they increase the demand, they increase the supply of the USD, okay? At the same time, when we look at the capital account, so let's look at just this number over here. So this is the amount of investments that US investors invest overseas, right? So when they invest overseas, they will be buying assets from overseas, and therefore they'll be paying their USD to the trade partners, yeah? So as you pay, you increase the supply of your currency, okay? On the other hand, if we look at the amount of foreign investment into the US, so for example, if we just look at the direct investment, right? So this number tells you how much foreign investors invest directly in the US economy, yeah? So when they invest in the US economy, they demand the USD to pay for their investments, right? So as they demand the USD, they affect the demand in the market, right? So the more the demand from foreign investors, the higher the demand for the USD, right? Finally, let's look at the central bank's actions. So this is the US central bank, right? So in this case, what happens is, as we mentioned before, this is a positive number. So the US central bank actually sold off some of their foreign reserves to get the USD back, right? So in a sense, they create more demand for the USD, yeah? Does that make sense? So when you sell foreign assets in exchange of your own currency, you're increasing the demand of your currency, right? Okay. So in some countries, what happens is when your current account is very, very much in deficit, which means that you buy too much and you don't sell as much. So when the current account is in deficit, a lot of countries would try to improve the balance of payments by depreciating their own currency, right? So when you depreciate your own currency, in theory, that makes your goods and services cheaper, and therefore it should increase the demand for your goods and services, right? And that will help the exports, okay? So when your goods and services are cheaper, people demand more for your own goods and services, and therefore exports should increase. But in practice, when a country depreciates their own currency, their balance of payment actually gets worse before they improve, yeah? So this is what happens to the balance of payment when a country depreciates their currency, okay? So at first, it will go even further down, and then eventually it will pick up, okay? So why is that the case? See if I can show you. Here we go. So this is a phenomenon when we call a J-curve, right? Which is what happens when country depreciates their currency in an effort to improve their balance of payments, right? So this is time, and this is your balance of payments. So at first, your balance of payments will get even worse, and then it will start to pick up, okay? So why is that the case, right? So when we depreciate our currency, in theory, our prices should go down, and therefore foreigners should be demanding our goods and services a bit more, right? In practice, what happens is that when you depreciate a currency, the price elasticity of goods and services might not change immediately, right? So what do I mean by that? So suppose, for example, Australians really like iPhone, right? So we really, really like iPhone. Doesn't matter how much the iPhone is worth, we would want them to buy a new iPhone as soon as they come out, right? So our demand for iPhone is very, very price inelastic, okay? So suppose that this is the case, right? So demand is not very much affected by prices at all, because this is due to a preference, yeah? So what happens when the Australian government decides to depreciate their currency? Okay. So when we import iPhones from the US to Australia, if we depreciate our currency, hoping that our consumers would change our consumption behavior, But if it's not the case, if the consumers will still have a preference for foreign goods, what would happen to our trade account is at first, right? So suppose at first the price of an iPhone is 1,000 Australian dollars, and the current exchange rate is for every one USD, we can buy 2 Australian dollars, right? Now, suppose that we depreciate our currency, so our new exchange rate is that for every 1 USD, we will need to pay 4 Australian dollars, right? So we depreciate our currency by 100%, okay? So before, when the price was 1,000 Australian dollars, this is when the exchange rate was 1 USD per 2 Australian dollars, right? That means for every iPhone, we will pay 500 USD to get an iPhone before, okay? Suppose we have 10 Australian citizens buying iPhones. That means our import will be $1,000 times 10, right? So that's $10,000, okay? Now, after we depreciate our currency, everything else is the same. An iPhone is still sold at $500 US in the US. But now for an Australian citizen to buy an iPhone, we will need to pay 2,000 Australian dollars, right? Because the currency value has decreased. So we pay more Australian dollars for the same amount of USD, okay? Now, because the demand for iPhone is very, very inelastic, meaning that doesn't matter how much it is, Australian citizens will still buy the iPhone, okay? If that's the case, then our new import value would be $2,000 times 10. I still have the same demand, I would just have a different price, right? So in this case, our import value would increase to $20,000, okay? So we were hoping to decrease our import to a lower number before to improve our balance of payments. But in this case, because we did not think about the elasticity of our demand, it actually makes the situation worse, right? So our import actually increases, and that further reduces our balance of payments, right? It further reduces the value of our trade account, okay? So therefore, if we assume that nothing happens, nothing changed to the exports, if we take exports minus imports, we will find that the balance of payment is further reduced, right? Which explains this bit over here. So after we depreciate our currency, our balance of payments actually gets worse, okay? So eventually, if people start to realize that it's too expensive now to buy foreign goods, they will start to change their behavior, in which case the balance of payment hopefully will get better, right? So this is a situation a lot of countries run into when they depreciate their currency, okay? This happens when you have a very inelastic demand. Okay, so we talked about this before. Okay. So in the last bit of the lecture, we'll talk about the different trends in the balance of payments over time. So the US being one of the most important economies, let's look at how their balance of payment trades across time. So on this graph, we have the balance of payments for the US from the 1980s to 2014, right? So we are tracing two different types of accounts. We're looking at their capital accounts as well as their current accounts, yeah? So what do we have here? So in terms of their capital accounts, they were mostly positive over time, yeah? Whereas for the current accounts, they were mostly negative, okay? Can someone explain to me why their capital account has always been positive over time? So when you have a positive capital account, that means foreign investors invest more in the US, right? They hold more US assets relative to US investors, okay? So if we go back to our previous lecture when we talk about the gold exchange standard, right? The gold exchange system. So where we have the US currency pegged against the gold, and other countries will hold the US dollars as their foreign reserves, right? So when other countries hold USD as their foreign reserves, effectively they are buying US assets, yeah? So they're demanding the US currency, okay? So when they demand US currencies, it will create a positive capital flow into the US, right? So they are buying US assets, okay? So in this case, because of the role of the USD in the monetary system, by definition, they will run a positive capital account, right? Because other countries are holding the USD, okay? Now, because of the balance of payment identity, when you have a positive capital account, you have to run a account deficit in your current account, right? So your current account has to be in deficit, okay? So the problem here is that whenever you have a current account deficit, it means you are consuming too much, right, relative to how much you can produce. And if you have a person that consumes too much relative to how much they earn, what do you think about their financial well-being? Not too well, right? So if I have a credit card and I keep using my credit card without being able to pay it, I might not go very far, right, in terms of my financial situation. So the same situation happens here on a country level. So when you have a country that runs account deficit for a long time, normally it's not a good thing, and people will start to stay away from that country, right? The only exception here is the US, where we see that investors still invest in US assets, despite them having a negative trade account for a long time, right? Why is that the case? So once again, this is because a lot of governments around the world still hold the USD as the foreign reserves, right? Because of that, there is still a positive capital flow into the US, despite their long-running trade deficit, okay?
Won't that depreciate the value of the USD though? There's full supply and demand.
Yeah, so there's an offsetting effect here. So when you have a trade account deficit, your currency value should depreciate, but at the same time,
High demand, it doesn't depreciate.
sorry?
Because it's so highly demanded, it doesn't.
Yeah, spot on. So because you have demand from somewhere else, it kind of offset the effect. Yeah. So in Japan, on the other hand, we see the opposite, right? So with Japan, they run a persistent current account, positive current account. And at the same time, because of the balance of payment identity, their capital account is negative, right? So this is because Japan has been, for a long time, has been a net exporter in the world, right? With their financial centers and with their car industry, right? So to sum up, as we mentioned before, when you have a current account deficit, that means you are a net buyer, so you're consuming more than what you're selling. And if you have an account deficit, then most likely your capital account will be in surplus, right? Because these two have to offset each other. So in terms of the current account balance, so this is when we look at just the trade account, right? So if we look at different countries, the light areas are when countries have a negative trade account. So this is when you have a trade deficit. And the darker areas are countries where you have a positive trade account, right? So this is trade surplus. So when you are a trade deficit country, you are a net consumer. And when you are a trade surplus country, you are a net producer, right? You're selling more than what you're consuming, okay? So overall, as we mentioned before, the US has been the net consumer of the world. Australia is also a net consumer. And some other countries like China or some Southeastern Asian countries, these are net producers, right? Okay. So the last thing I wanted to show you guys is a graph showing how foreign investors invest in the US, so who hold more assets in the US, right? So in this case, we are just looking at the creditors, so those who hold debt issues by US corporations or US government, right? So what we see here is we're looking at the foreign holdings of long-term treasury debt. So this is government debt by the US government, yeah? So who are the creditors for the US government? The first one being China, right? So China has a sizable holdings of US debt. The second is Japan, followed by other countries, right? So we have a few Asian countries here in the list. So what does it mean to us? So if we look at China, for example, so from 2005 to 2010, they have been increasingly holding debts in the US, yeah? So this tells us that over time, China has saved up enough money to be an investor around the world, right? And this coincides with their trade surplus as well. So for a long time, they have been a net producer of the world. That means they produce more than they consume, okay? So they have to save up their money somehow, right? So one way that they save up their money is to buy investments in other countries, okay? So have holdings in other countries, yeah? So with the net savers being the net producers of the world, they will be holding assets in other countries, okay? So is Japan, right? Another thing that we noticed from the graph is that the amount of government debt in the US has been steadily increasing over time. So from 2005 to 2010, it has almost doubled, right? It has more than doubled the amount of debt, okay? So why is this important? So if you look at what happened to US household debt before the financial crisis, you will see that before 2008, the amount of household debt has been steadily increasing, right? So when you have a very high level of debt, it's when bad things could happen, right? Right now, when we look at corporate debt, US corporate debt, we see the same picture, right? There has been a very big increase in US corporate debt over time, and that could be telling, right? Especially when we have the virus situation at the moment, okay? So we'll see how things go with US companies in the near future. But that's quite concerning from my point of view. Okay, so just to sum up, so from last week to this week, we look at how exchange rates are determined, what are the different factors that affect the exchange rate values. The biggest factor is how the exchange rate regime is set up, right? So your exchange rate value might be determined by what your government wants your exchange rate to be, okay? So when we import and export to other countries, as we show in today's lecture, it might affect the currency value through the demand and supply of the currency, right? Finally, currency valuation is relative, meaning that when we value our currency, we have to base it on another currency, right? So when we talk about the Australian dollars, we base it on, say, for example, the USD, okay?